This is Ken Boyd, the owner of St. Louis Test Preparation, and this is a video from my blog called You Won't Like the Way You Look, Men's Warehouse Rejects JosA Bank's Merger Offers Insufficient. So I have some news sources here. So let's go through the point of the blog post first. So JosA Bank had approached Men's Warehouse about a possible combination of the two companies. They'd be a pretty big powerhouse in men's apparel if they combine. We find out that JosA Bank is smaller than Men's Warehouse. Now, there's a reason for this combination from JosA Bank's perspective. It could help the companies cut costs because they can combine and have more leverage when they buy products. JosA Bank has 600 stores. Men's Warehouse has a lot more, selling 1,137 stores. They also had this tuxedo business at Men's Warehouse, which we'll talk about. There's been some turmoil in the boardroom. George Zimmer, the guy you see on the commercials, has been forced out to an extent. I'm going to skip through that. They talk about how Men's Warehouse has changed its product line to add a slim fit line, and they also rent tuxedos. So, the question and the real point of this video is a very interesting thing that Men's Warehouse did. They actually created a presentation to their investors justifying why they rejected the JosA Bank offer. And what I'd like to do is to take a spin through that. Here is the presentation. And so I think it's beneficial to find out some things about why they rejected the offer and how they relate to accounting. The first thing they point out is that, in their opinion, Men's Warehouse, JosA Bank is taking advantage of a short-term drop in the stock price. That's part of their argument for not doing this deal. So that's number one here, taking advantage of a temporary dip in the stock price. Men's Warehouse goes on to say, look at us financially. We have solid long-term performance. So we have sales, we have EBITDA, earnings per share, and then there's a term called CAGR that's up here in the corner. And I just want to remind everyone that EBITDA refers to earnings before some deductions like taxes, interest, depreciation, and amortization. So before you deduct these three things, what are your earnings? It's a common number, a common benchmark to judge profitability. This other number that you don't see a lot is called compound annual growth rate, CAGR. And the definition is the rate at which the company would have grown if it grew at a steady, constant rate on a compound basis. So Men's Warehouse says, look at us compared to our peers. We've got pretty good performance compared to our peers. The peers are the lower number, and Men's Warehouse is the top number, and they seem to be right there, at or better than their peers. Then they talk about one thing that we do at Men's Warehouse is stock repurchases. Stock repurchases. Now let's think about that issue for a minute. Men's Warehouse MW stock repurchases increase shareholder return. Well, how do they do that? Well, if you consider the earnings per share formula, which is earnings available to common shareholders divided by shares outstanding, when you buy back shares as a company, you have fewer shares outstanding. Assuming the same dollar amount of earnings, that means a higher earnings per share per common shareholder, which means even without any financial performance numbers, each share is more valuable if you buy back shares. And another one that's critical is, and they say it several times in the presentation, is same store growth. Same store growth in sales. Let's talk about that for a minute. It's a key financial measure if you're a retail store, because what it says is that your plan is succeeding for sale because it's apples to apples comparison. So you've got a store open. It's been open all year 2011, 2012, 13. If sales increase, that means that your plan is succeeding when you do an apples to apples comparison of sales with one store over a specific period. And store performance is improving if you have same store sale growth. Free cash flow is mentioned several times in the presentation. You can see here at the bottom, in sort of that brown color at the bottom of the chart. Over $500 million in free cash flow generation in the next 3 years used to finance continuing growth and return of capital. Let's talk about free cash flow. This is the Wikipedia definition. Operating cash flow from operations. Think about the cash flow statement. From your day-to-day doing business, buying product, paying salary, collecting payments from customers. That's operating cash flow. So free cash flow is designed as operating cash flow less those capital expenditures that you have to make to provide for the assets you need to run your business. So if they have to spend money on furniture, fixtures, buildings, those kinds of things, those are capital expenditures. Store displays, I would imagine, could be very expensive if they have to be changed. So what Men's Warehouse is saying is, we're generating extra cash, if you will, and that could be used to grow, to add on stores, product lines, advertise, or it could be used, again, to repurchase shares. That's what we could do with our free tax cash flow. Don't want to go too far here. Let's go down to slide 11 and 13. So they start making the point on slide 11 about tuxes, that they do tux rental, and that's become a big part of their business. And if you go down a couple of slides, it says here over 300,000 wedding parties served in 2012 and only over 50,000 student proms. So this gets a younger audience into their store, which is a demographic they're going after. They also added JosA, the fashion designer, as a line, a product line. And if we go back one slide, here's the JosA logo and the fact that they're trying to move into what they call exclusive brands, brands that they specifically have that they can charge more for. It says under here, they combine the tuxedo rental and JosA by offering JosA tuxes, which they can charge a higher than average price for. If you follow JosA Bank, I'm in St. Louis and we have commercials all the time. It's become a kind of a tradition that JosA Bank gives away a lot of things in their promotions. Buy a suit, get 3 shirts free, etc. Well, the problem is their typical client is very price sensitive when it comes to their product. I'm going to skip way down to what I thought was an interesting slide. You can see that under JosA Bank, their core customer is 35 to 55, where Men's Warehouse is a younger customer. And they say they're very price sensitive, which means they really need a bargain to go out and shop because they're used to hearing all that JosA Bank marketing on big discounts, giving stuff away, buy one, get one free. That is a risk because that is a risk to their margins. So I thought that Men's Warehouse did a very interesting job of presenting their case. You can go through the rest of this document and see more about their marketing strategy. Here's some more on their track record and how they've outperformed. Really interesting stuff. Remember that stltest.net, besides our tutoring service, if you go to our cost accounting video textbooks, we have complete videos on instruction. You see accounting for investments and advanced accounting. Now you'll get a MP4 full-length video. You'll also get the Excel templates I use to make the videos, a practice exam in Excel, and you'll also get a video with the answers to the practice exam. I hope those are helpful with future courses. Thanks very much for watching, and we'll see you next time.